Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's @Finance, and if you want to join our community, finding-value.com. I dive deeper into all these topics, sectors, looking for investment opportunities, sharing those opportunities with everybody in the community. I talk about individual companies, sectors, and they basically span across the whole commodity complex. If that's something that interests you, definitely try it out. Special is a coupon code that can get you savings on both the monthly and yearly memberships. So Isabel, that the S&P 500, when the S&P 500 is within 2% of an all-time high and the Fed cuts rates, historical data since 1980 shows that the index has risen 100% of the time over the following 12 months with an average return of 13.9%. So yes, the Fed has cut near all-time highs, and the bulls loved it. Um, we are at kind of a critical area. Critical area, if you look at history and do a dot plot is just putting the valuation of the S&P 500 in relationship to the interest rates. We see a positive correlation of the S&P 500 going up with interest rates so long that interest rates are below roughly 4.5–5%. As interest rates go above 4.5–5%, the the correlation diverges, and we see the stock market go down as interest rates go up. So that's historical data there. So if we're at all-time highs and rates are close to where we are today, and if they were to be pulled back away from the 4.5% level, I would suspect that we could see the S&P 500 go higher if we get lower rates. That's a big if. Now, a lot of people are thinking that rates will go down, that the Federal Reserve is going to cut rates and that rates will actually go down. That may not be the case. So if we got some data here, we'll go through it here soon, with producer price index going up. Producer price index generally goes up first, and then it flows through the system into consumer price index. So if we see the PPI divided by CPI, well, it's probably US in front of this. So if we see this go up and we start breaking higher, what that means is that the producer price index is going up faster than the consumer price index, and that inflation will come. That's an inflationary wave like this. And we're kind of consolidating right now into a corner, and that hasn't really broken out yet. But I think with the latest data, we'll see what that looks like with the latest data and how that actually plays out. So if they lower rates and rates actually go lower, the S&P 500 goes up because we're at that crucial area of 4.5–5%, and then we would back off of it, and I think we would go up. But that doesn't mean that rates will go down if they lower interest rates. The short end of the curve does not dictate 100% the long end. So make gold great. Inflation shocker. So the biggest PPI, producer price index, jump since 2022 year over year is now 3.3%. 2.5% was expected. Well, poor jobs plus hot prices equals the Fed is trapped. They cut rates and kill the dollar, or they hold rates and kill the economy. And that's, back in 2021, I mentioned that the Fed was backed into a corner and there was no good way out of it. This is the corner that I was describing, that even if the rates, or let's say if unemployment goes up, what is the Fed going to do? They're trapped. If you cut your rates, you'll destroy the dollar, but you're saving, quote, the economy by doing that. Or if you hold rates to save the dollar, you kill the economy. So they're kind of trapped. Any decision that they make has a bad outcome. I call that a predicament. It's not a solution. So problems have solutions. Predicaments have outcomes that you have to manage. And I think that they have a predicament where there's no good solution and you have to start to manage outcomes. Cash on the sidelines, wait a minute. So when cash on the New York Stock Exchange drops, it means investors are heavily into stocks. Adjusted for M2, the trade looks even more crowded. Even with more money circulating, cash on the New York Stock Exchange is still very low, meaning investors are really leaning into stocks compared to what's available. In short, FOMO, people are low on cash and heavily invested in equities, especially when adjusted for the money in circulation. Last time it was this extreme, but we have AI this time. No worries, right? Dot-com bubble, extreme level, and we're back to extreme levels. Is this going to result in a big crash? My answer is yes, it will. I think it will. Why do I think that? Because it's extremely overvalued. We know the cash is sitting over there based off ratios of other asset classes compared to the stock market. So yeah, we're just going through the cycle. Is there going to be a higher high or a complete, a top here? Sure, there could be. I don't know when it will exactly peak. I don't think anyone knows. But yeah, this is what you avoid. It's investing isn't hard if you just apply logic to everything. So if you can avoid getting emotional, you're fine. So what people do is they get emotional and they run in at extreme levels like this. This is not where you want to be. Yes, down here when everyone's afraid, this is the best time to be in this. When you're way down here doing a shoulder, head, shoulder bottoming pattern, and then you break out and you go into an uptrend. Now it's the exact opposite. You want to get out, sell, and you want to go grab other undervalued assets in a different sector. And then the cycle just goes back and forth. The cycle here in 2000, you would have been fantastic to go buy a bunch of gold and silver, a bunch of oil and commodities and copper, and then sold it down here in 2007, 8. And that would have been one heck of a trade. Now, then you would have sold that and bought the S&P and the NASDAQ, and then you would have rode it all the way back up. Now, would you have done that perfectly, perfect? Probably not. No one does. No one knows the exact top. No one knows the exact bottom. But that's the cycle. That's what logically someone should do. So if we're up here, I'd be swapping over into commodities and precious metals. I'd be buying silver and gold, and that's exactly what I did. I swapped it. I swapped it in 2020 though, and I did that because the valuations on all those companies in 2020 were ridiculous. I mean, ridiculously cheap. Edward Dowd says soon. TLT, one of the longest setups known to man. Watching and waiting. So we're in this corner here, and we hit this support, hit this support, hit this support. Are we going to break down? And if we break down, that means rates are going to break up. Bonds will be one heck of a horrible area to be in. So that's interesting. I don't know if they mean long, meaning they think it's going to break higher. I'd be watching for the downside, for bonds to sell, get sold off, and interest rates to go up. Callie Cox, PPI's numbers were more shocking, but they told us the same story as Tuesday's CPI report. Companies are passing along current and future costs. Congrats, you're paying for tariffs. Inflation heat has spread to service prices. A September rate cut is not a done deal. So congrats, you're paying the tariffs. Here we are heading higher here. That's at least what this is saying. For the producer price index, that goes up first and then eventually it works its way into the consumer price index. Urine Timmer. So he says, with expectations for September rate cut now at 90%, the bond market remains very calm. The forward curve now predicts a terminal rate near 3% in 2026. So this is kind of the slowdown. This could impact some of the investments too, if rates actually follow this path. What that means is that you should see gold and silver really light it up in 2025. And then as you go through it, you'll bottom in 26, and then your inflation stuff starts to heat up again over here. So that's kind of what I see. We had a big inflationary boom kind of coming up as this goes higher, and then we kind of cool off after it, depending on what they do here around the world, and then we head up again. So usually during the cool off period, gold and silver do very well, and then energy usually gets hit in the face a little bit. It chops sideways and consolidates during that time frame. So I would do the opposite. Do the opposite of everyone else. When this goes up and we get to a spot like over here, and gold looks like it's trying to bottom, you want to buy gold. And that's what we did. Now, as this comes down, we want to be looking at energy in other areas, putting in bottoming patterns for entry points. So when that bottoms and starts to move higher, which some sectors are, that's how you play it. Most everyone looks at the news, and the news is almost always too late and incorrect. You need to look at positioning in the market and the patterns that are being created from the positioning. The herd psychology imprinted on the chart. That's what you want to do. But a lot of people will look at news and say, well, they're saying that interest rates could still go lower. Well, yes, that means that gold and silver can still move up. Yes, agreed. But that doesn't mean just because they're going lower that you won't be seeing bottoming patterns in the inflation sensitive stuff. Looks about correct from Eric Yoon. It says one possible path. So Powell cuts, bond yields rise. That's what I'm worried about. He cuts. So if the Federal Reserve, a lot of people think that they control interest rates with 100% control. They do not. They need to get in there. They need to destroy something. They destroy the dollar to save the bond market. So they create currency, buy bonds, so yields actually drop. So what the market could do is Powell cuts and they say, wrong move, buddy. And people sell bonds because they are anticipating a weakening dollar, perhaps, or further inflation. Like they're not taking the inflation we have in the system serious. So it sparks more selling pressure in the bond market. Stocks inflate because money gets sold from bonds and goes and migrates somewhere else, and it could be the stock market. Gold rallies, systemic crash, yield curve control. Systemic crash means that the interest rates could spike, things could start to crash, and then you get your yield curve control where they print a bunch of money and go out and buy bonds to hold interest rates at a level that they deem necessary to hold it at. There's this like that could be one of the paths that gets created here. Stop worrying about bear markets. So here's the bear markets and the little ones in the red, and then the bull markets are the big blue ones. So obviously, if you were to look at this, you'd say, well, it'd be much more beneficial to be a bull most of the time because on a percent basis, the stock market goes up more than it goes down. But yeah, a lot of people get scared about recessions and it keeps them from getting invested. This is just saying, look, we've been in a lot of bulls. Stop worrying about these little bear markets. I don't even think a 19% pullback is that bad. I really don't think it's that bad. In the commodity space, hell, you get 50, 60, 70% pullbacks. I mean, this is a breeze. This is nothing. That's nothing. Tavi says, of course he thinks the BOJ is behind the curve. The US desperately needs other central banks to tighten their monetary policies to help devalue the dollar. And that's in response to US Treasury Secretary Scott Bessent criticizing the BOJ's cautious approach to raising interest rates, saying it was falling behind the curve. Here's your evening briefing. So, what determines the strength or weakness of the dollar? Well, if we don't raise rates in America and the BOJ raises its rates, that means that the yen will appreciate against the dollar. So the DXY will get weaker. If Bessent and Trump want a weaker dollar, you need other central banks to be tighter than what you are. So you either cut rates while they don't cut, or they raise rates while you don't raise rates. So that's kind of what they need in order to weaken the dollar. Eric Nettle says it's not just OPEC. Brazil and Guyana both have large projects coming on stream imminently. Guyana to add 290,000 barrels per day beginning next month, and Brazil 400,000 barrels per day of new capacity later this year. Cause for pause short term, yet we remain bullish on oil over the medium term. So that's what's coming online for non-OPEC additions out in, we'll say, the second half of 2025. Those are the new projects. After that, there isn't much. There isn't much after that. Then it becomes real dicey on where oil is going to come from. If shale rolls over, well, we need to not just replace shale oil, we need to replace whatever demand growth there is too. So things get real dicey, I would say, in 2026 and on past that. Peter Schiff says July PPI soared 0.9% month over month, far in excess of the plus 0.2% that had been expected. It was the biggest jump since June of 2022, sending year over year PPI up 3.3%, the highest since February. A CPI spike is next, Consumer Price Index. So much for rate cuts. I wonder who Trump will fire for rigging the PPI to make him look bad. Are we going to get that rate cut? I don't know. I don't know. A lot of people are trying to figure out what's going on here. To me, it looks like inflation's coming back into the system. And usually when inflation comes back into the system, rates are not lowered. They're held steady or they get raised. Jordan says silver stocks just broke out from a 12-year base. Junior silver stocks are close behind it. It's a much smaller sector than gold stocks, and I don't have breadth data. I might create at some point. Because it's smaller, less money is involved. Data and metrics can be less reliable. So SILJ breaking out here, looking pretty dang good. And this is also SILJ on the weekly, right at resistance. So we're looking for a breakout on SILJ. That's what we want to see. And that's a big pattern. And I think we're going to see a launch from it. So it depends on what interest rates does too. I think if we get a slowdown and we lower interest rates, I think this is gonna move big. Same with gold and silver and the mining companies. Breakaway free futures AM update. Dry bulk, Capesize flat, Panamax flat, and tankers are both up 1%, VLCC and Suezmax. Saudi Aramco and S&P are certainly betting on all-time high global oil demand this summer, with exceptional consumption numbers so far. Despite supply additions, global crude oil and product inventories have remained in a tight band all year, further supporting this outlook. This is monthly global demand. Look how high we're going here, guys. 103.5 in the beginning of the year, and August 108. That's a 4.5 million barrel swing there. That's a lot. That's a lot. That's a high demand, 108. That's crazy, actually. Absolutely crazy. But that's where I'm going to end it, guys. So that's all I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We have a Q&A session coming up at Saturday, 7 a.m. Mountain Time. I'll see you guys there. And that's all I've got for today. So we'll catch you next time. See you later.